Welcome to the Deep Dive. Today we're really digging into the recent performance of a major financial institution, Regions Financial Corporation.
That's right, big player.
Our mission is to take their second quarter 2025 earnings call and report and, truly unpack it.
Get into the nitty-gritty.
Yeah. You'll get the most important insights, helping you understand not just what happened, but, why it matters.
And how it connects, right, to the broader financial landscape.
Exactly.
We've got a pretty comprehensive set of sources here. I mean, from the detailed numbers to the strategic thinking behind them. We'll be extracting the core takeaways, giving you a clear sense of their financial health, their future outlook, and maybe even some surprising insights into, how a large bank makes these crucial decisions in today's economy.
Right. You're going to walk away with hopefully a crystal clear picture of how they're navigating the current economic current.
Yeah, the currents out there.
What they're betting on for the future and sort of what makes a bank tick. Okay, let's unpack this deep dive. So to kick us off, let's talk about the headline numbers for Regions Financial in Q2 2025. What was the big story there?
Well, the most, I think, fascinating thing here is their remarkably strong overall performance, really solid.
Okay.
They reported net income of $534 million. That's 0.59 cents per diluted share. The adjusted figures were actually slightly higher, $538 million and 60 arch per share.
And revenue?
Total revenue hit $1.9 billion. That marks a pretty significant 10% year-over-year growth.
10%, wow. Those are strong initial figures. What's the key driver behind that revenue growth, and how did their pre-tax, pre-provision income fare?
Yeah, PTPP income, that really tells a story of efficiency. It increased by 14% year over year.
14%.
Reaching $832 million. And this robust performance, it also translated into a solid 19% return on tangible common equity, ROTCE.
19% is quite high, isn't it?
It is. That's not just a good number. It actually places them pretty high among their peers for efficient capital use. It shows how effectively their, recent strategic investments are translating directly into shareholder value.
Okay, so what does this all mean for you, the listener, maybe navigating your own financial landscape?
Well, it means a major bank is showing consistent, impressive momentum.
Right.
And it seems driven by very deliberate investments they've made in talent, technology, and core capabilities, and those are clearly paying off.
Let's dig into how they're generating this revenue then, starting with net interest income, NII, which is usually the backbone, right?
Absolutely. And NIR saw a robust rebound. It increased by 5% linked quarter, so compared to Q1.
Okay, linked quarter.
Yeah, up to $1.259 billion. Now, this was largely due to the positive impact of fixed-rate asset turnover and actually better deposit pricing performance than they'd expected. It really exceeded their initial estimates.
Interesting.
Points to some very savvy treasury management, I think.
So what's particularly compelling here, you mentioned deposits, is their ability to manage deposit costs lower, even when acquisition costs for new deposits are higher. How do they pull that off?
Yeah, that's a great question. It really raises this important point about their significant funding advantage.
Okay.
They've managed to keep non-interest-bearing deposits in the low 30% range of their total deposits.
That's quite high.
It is, and it's absolutely critical to keeping their cost of funding low. And get this, they achieved a cumulative deposit beta of 35% on the down cycle.
Can you unpack deposit beta a bit for us?
Sure. So essentially it means they've been incredibly effective at holding onto those deposits and keeping their funding costs contained even as market interest rates have fluctuated. A low beta means their deposit costs didn't rise as much as market rates did.
Got it. So they're holding costs down.
Exactly. Plus, they're adding new fixed-rate loans and securities that yields about 140 basis points. That's 1.4 percentage points above the yield on the stuff that's maturing.
So replacing lower-yielding assets with higher-yielding ones.
Precisely. It creates this powerful tailwind, as they called it, that's expected to help them for, multiple years, potentially.
Okay, so beyond interest income, their fee revenue also saw good growth. What were the standout areas there? Where else are they making money?
Yeah, good diversification story. Wealth management continued its really impressive run, another quarter of record fee income.
Oh.
And it's been growing at more than an 8% compounded annual growth rate since 2018, so that's consistent long-term success there.
It's significant.
Then capital markets revenue, that also grew 5% linked quarter. mostly driven by M&A advisory and some real estate activity. That shows a 14% compounded annual growth rate since 2019.
So different areas contributing strongly.
Right. And mortgage income jumped 20% linked quarter. Now, part of that was a $13 million favorable adjustment on mortgage servicing rights valuation.
Okay, bit of an accounting tailwind there, too.
A little bit, yeah, but still strong underlying performance. And even card and ATM fees increased, mostly due to, seasonally higher transaction volumes. It shows really broad-based strength in their non-interest income streams.
Generating strong revenue is crucial, obviously, but it's only half the story, isn't it?
Yeah.
How do they manage their expenses this quarter while, still investing for the future?
Right, balancing act. So adjusted non-interest expense, it did increase by 4% linked quarter.
Okay, what drove that?
Well, a primary driver was salaries and benefits. That was up 5%. And that was influenced by a few things. An additional workday in the quarter, the full quarter's impact of merit increases kicking in. And also higher revenue-based incentives because revenue was up. They also added over 100 full-time equivalent associates during the quarter.
So they're investing in people?
Yeah, indicating continued investment in their workforce.
Okay, so despite these investments, they're still committed to positive operating leverage. For our listeners, what does that concept actually mean, and how do they plan to make revenue grow faster than expenses?
Right. Positive operating leverage, it simply means they expect their revenue to grow faster than their expenses over time.
Okay, the gap widens favorably.
Exactly. They anticipate generating full-year positive operating leverage in the 150 to 250 basis point range, so 1.5% to 2.5%.
And how do they get there while still investing?
Well, while they will continue to make strategic investments, especially in technology, they are laser-focused on internal efficiencies.
Okay.
They plan to leverage new technologies, including, interestingly, artificial intelligence, to automate tasks.
AI and banking.
Yeah. And the idea is to allow for natural attrition, people leaving voluntarily, which is about 6-7% of their workforce annually, to manage headcount over time, rather than just automatically backfilling every single role.
So using tech to absorb some of that work, potentially.
That seems to be the plan. And this isn't just a short-term goal, it's baked into their 3-year strategic plan. All their business units have to build positive operating leverage into their budgets.
So it's a cultural shift, almost.
Yeah, it seems like a fundamental shift in how they view growth and efficiency together.
Let's dig into the core of their banking business then. Loans and deposits. How did their loan book look this quarter? Any major changes?
Well, average loans were pretty stable, actually. But ending loans, the snapshot at the end of the quarter, they grew by about 1%.
Okay, modest growth. Where did it come from?
Particularly in the consumer and corporate bank segments. Business loan growth was notably strong in areas like structured products, manufacturing, and also some previously approved multifamily real estate projects that are just continuing to fund up now.
Right, drawing down on existing commitments.
Exactly. And looking ahead, their overall pipelines, which indicate future loan activity, were up a healthy 17% over last year.
17% pipeline growth. That sounds promising. So what does this tell us about their overall loan growth strategy? Are they pushing hard for expansion, or is it more nuanced?
This is where it gets, I think, truly interesting. They have a very disciplined approach. They're clearly remixing their portfolio, even if it means more modest overall growth numbers right now.
Remixing? What do you mean?
Well, for example, over the last year, they deliberately exited almost $1 billion in leveraged lending and enterprise value lending relationships.
$1 billion. Wow. Why?
Primarily in the technology sector. The reason they gave, they just weren't seeing the appropriate returns for the risk involved.
Okay, so shedding lower return, maybe higher risk assets.
Precisely. And they expect about 500 million more of this kind of runoff by the end of the year.
So this isn't just being conservative, it sounds strategic.
I think so. In a market where credit quality can turn quickly, their willingness to shed less profitable or riskier assets, even if it dampens the headline growth number a bit, it demonstrates a calculated trade-off. Volume versus profitability and resilience.
Right.
It could prove exceptionally smart in the long run. Their view seems to be, grow with the economy plus a little bit extra in their specific markets, unless they're actively reshaping the portfolio like this.
Okay, makes sense. And what about deposits, the other side of that coin? How's their deposit base holding up? Still a strength?
Oh, absolutely. Their deposit base continues to be a major strength. They grew average deposits by 1% during the quarter.
Stable growth there, too.
Yeah, and they observed positive trends across both their core markets and what they call priority markets.
Okay.
In fact, consumer deposits in those priority markets grew 20% more than in the core markets during the quarter.
So the focus is working?
Seems like it. They really emphasize their focus on growing those sticky consumer checking accounts.
Mm.
They have nearly 4.5 million customers there, average balance around $5,500.
Hmm.
And also core operating accounts for businesses. 400,000 small business customers, average balance $15,000.
Real relationship banking.
Exactly. And this customer-centric approach, they say, has driven over 30% organic growth in total average deposits over the last 5 years. That's among the best in their peer group.
30% over 5 years is impressive organic growth.
It really is. And they expect to maintain that high mix of non-interest-bearing deposits we talked about, which, again, is just crucial for their funding advantage.
Okay, in today's, let's say, dynamic economic environment, asset quality and capital strength are obviously paramount for any bank. What's the picture here for Regions? Still looking healthy.
Yeah, overall, quite healthy. They reported that client resilience remains strong, and their underlying asset quality metrics broadly improved in Q2.
Good news. What specific metrics showed that?
Well, annualized net charge-offs, NCOs, they actually decreased by 5 basis points down to 47 basis points.
Lower charge-offs, always good.
Very healthy sign for their loan book, especially, compared to some industry averages. And non-performing loans as a percentage of total loans, that improved by 8 basis points down to 80 basis points. Another positive indicator. Even criticized loans in their business services portfolio improved by 6%, so broad improvement.
They did mention, though, some specific portfolios that are still under closer scrutiny, right? Not everything is perfect.
That's right. Transparency there. They are actively working through, as they put it, a handful of credits in the office commercial real estate space.
Not surprising given the headlines about office CRE.
Exactly. They acknowledge that sector still faces headwinds. They also noted that the transportation sector continues to be stressed.
Okay.
However, crucially, they've proactively reserved for these anticipated losses. They feel they're provisioned for it.
So they expect losses, but they've set money aside.
Correct. And they actually expect net charge-off to decline in the fourth quarter after being generally in line with Q2 levels for Q3. So they see a path through it.
And the consumer side.
They pointed out their consumer portfolio is generally robust, particularly because they focus on homeowners who have good equity in their homes. That leads to, they said, negligible losses in their related mortgage or home equity portfolios.
So a targeted approach to risk management, it seems.
Very much so. Targeted and transparent.
And what about their capital position? How strong are their buffers, and what does this mean for shareholders?
Very strong. They ended the quarter with an estimated Common Equity Tier 1 ratio, CET1, of 10.7%.
10.7. How does that stack up?
That's well above the regulatory requirements, signifies a very strong capital buffer, gives them flexibility.
Okay. And shareholder returns?
Yeah, what's really fascinating here is their continued commitment to shareholder returns. They repurchased $144 million in shares in the quarter and paid out $224 million in common dividends. Plus, they just announced a 6% increase in their common dividend this week.
Another dividend hike.
Yeah, and they noted this continues a trend of over 10% compounded annual growth rate in dividends over the last 6 years. They actually claim that's the highest among their direct peers.
That's a significant point for investors, surely.
Absolutely. Demonstrates consistent value return. And just one more point on stability. Their available liquidity stood at about $65 billion. $65 billion.
Which they calculate is enough to cover their uninsured deposits at a ratio of about 185%. So ample stability there.
Okay, it really sounds like they're not just managing the present, but actively building for the future. Technology seemed like a major theme. Can you elaborate on their tech strategy? It sounded quite ambitious.
It really did. And this raises that important question about, how they're positioning themselves for long-term competitive advantage.
Right.
They are making significant investments to modernize their core technology platforms, not just tinkering around the edges.
Like what specifically?
Well, they've begun rolling out a new native mobile app. They're planning to upgrade their commercial loan system to a new cloud platform in the coming months.
Okay, moving to the cloud.
Yeah, but what's truly, I'd say, groundbreaking is their ambition to begin pilots on a new cloud-based deposit system in late 2026.
The core deposit system. That's huge for a bank.
Massive. With full conversion planned by 2027, they expect to be one of the first regional banks in the country on a truly modern core platform. And the benefit for customers, or for the bank.
Both, really. It should enable them to offer products and services to you, the customer, much more quickly and efficiently than competitors stuck on older systems. It's a huge undertaking, massive potential payoff if they pull it off.
Interesting. And they also touched on broader industry shifts, didn't they? Like the ongoing discussion around stablecoins. What's their take there?
Yeah, they weighed in briefly. They seem to believe there will eventually be a consortium of banks working together on some kind of stablecoin solution.
A bank-backed stablecoin.
Seems like it. And they intend to participate, basically following the lead of the industry, much like they did with things like Zelle and real-time payments.
So part of the pack, but maybe not leading the absolute charge.
That seems to be the approach. They also noted separately that the recent tax package creates more certainty for businesses,
Hmm.
and specifically bonus depreciation. They expect that to lead to an uptick in inquiries for things like heavy equipment purchases.
So a potential positive signal for business investment and loan demand.
Yeah, exactly. A positive signal heading into 2025 and 2026.
Okay, so bringing it all together then, what does this deep dive tell us about their growth trajectory moving forward? What's the kind of big picture outlook for Regions Financial's future based on this quarter?
Well, they certainly anticipate positive momentum carrying into 2025 and beyond. But that disciplined approach we talked about, focusing on risk-adjusted returns.
Right, not growth at any cost.
Exactly. It means they won't necessarily chase growth blindly. They expect to grow broadly with the economy, maybe a bit more, but really targeting those high-return, lower-risk opportunities.
Makes sense.
And I think the substantial proactive investments in that core technology, plus the talent acquisition they mentioned, about half of their planned new bankers, are expected to be hired by the end of Q3. That really positions them, I think, for continued growth and efficiency over the long term.
So building a more resilient, agile bank for the future.
That definitely seems to be the goal.
Wow, okay. That was a truly insightful deep dive into the workings of a major regional bank, from their robust financial performance to that strategic technology overhaul. It's clear there's a lot more to banking than just deposits and loans.
Absolutely. And if we connect this to the bigger picture, it really highlights how these established institutions are not just reacting to change, but proactively adapting, right, to a rapidly evolving financial landscape.
Hmm.
They're balancing those traditional strengths, like really careful credit management, with cutting-edge innovation and making, it seems, very deliberate choices about where and how they want to grow.
Exactly. And it raises, I think, an important question for you, our listener, to consider. Given this blend of digital transformation and that careful credit management we just discussed, how might these strategic shifts by banks like Regions Financial impact your own financial choices and opportunities in the years to come?
Yeah, that's a great question.
What aspects of how traditional banks are preparing for the future, resonate most with you? And how might that influence your own banking relationships going forward? Something to think about.